What's up, everybody, and welcome back to Coin Crusader, the channel that keeps you ahead of the curve in the wild world of crypto. I'm your host, and today we've got a packed show, so grab your coffee and settle in, because there is a lot happening in the XRP world right now. Jake Claver is back in the headlines, swinging for the fences with talk of a 4-digit, maybe even 5-digit, price target for XRP. We've also got Versan from Black Swan Capitalist dropping a theory about how this price move is actually going to unfold. And trust me, it's not the slow and steady climb a lot of people are expecting. On top of that, we're diving into a brand new interview that just hit social media, featuring developers building directly on the XRP Ledger, plus comments from Ashish Birla and insight from Franklin Templeton's head of innovation about what the future of digital wallets could look like. And to close things out, we'll get into the freshest updates on price action and what the Federal Reserve just decided that's shaking up the whole market. There's a ton to cover, so let's jump right into it together and break down what's really going on out there. Let's start with Jake Claver, because his name is back in everyone's feed. If you were following along last year, you'll remember he made some bold calls that, frankly, didn't pan out the way he promised, and a lot of people called him out for it. Now he's stepping back into the spotlight with another headline-grabbing claim, suggesting that under the right conditions, XRP could realistically reach a 4-digit price point, somewhere in the range of a couple $1,000s, within a fairly short window of time. His reasoning leans on a handful of major catalysts lining up at once: a potential unwind of the reverse carry trade, the possibility of BlackRock launching a spot XRP ETF, and instability around Tether that could send capital looking for safer or more liquid alternatives. He even goes a step further, arguing that if the derivatives market becomes fully tokenized, a price closer to $10,000 isn't out of the question. Bold stuff, and the kind of claim that's guaranteed to get clicks, whether or not it ends up being accurate. Now here's where it gets interesting, because tokenization of the traditional stock market isn't just some far-off fantasy anymore. It's already in motion. We've heard directly from leadership at both NASDAQ and the New York Stock Exchange, and even from the head of the SEC, all pointing toward 2026 as the year traditional equities start moving onto blockchain rails. Part of that shift involves moving toward what's being called 23/5 trading, meaning the market would be open 23 hours a day, 5 days a week, which is a massive change from the current setup. To make that kind of non-stop trading actually work, you need real-time settlement between clearinghouses and brokers, something the current system, run largely through the DTCC, just wasn't built to handle at that speed. That's where a fast, reliable settlement asset becomes essential. And that's exactly why so many people in this space believe XRP could end up playing a starring role if and when this transformation actually happens. Let's talk about the DTCC for a second, because there's a lot of speculation flying around, and I want to keep things grounded in what we actually know. The DTCC has been moving forward with tokenization initiatives tied to the Canton Network, and Ripple happens to be one of roughly 50 participants involved in that ecosystem. There's also been chatter around Stellar's involvement in similar infrastructure conversations. But here's the important caveat. The DTCC has not officially confirmed that XRP specifically will be used for settlement. I've looked, and it simply isn't out there in any official documentation. What we do know is that the DTCC holds a patent referencing both XRP and XLM related to security functions, which fuels a lot of the speculation. But a patent reference is not the same as a confirmed partnership. Ripple Prime is connected to the DTCC, but right now that connection appears limited to Ripple's own clients, not a broader DTCC-wide rollout. So while the pieces are intriguing, nothing here is locked in just yet. Now let's address the reverse carry trade conversation, because this one gets brought up constantly, and I think it deserves a serious, honest look instead of just repeating talking points for views. I've spent real time digging through Bank of Japan reports, BIS publications, and academic papers from Japanese economists. And I have to be straight with you. Not a single one of these sources mentions XRP as part of any carry trade unwind scenario. Could it happen down the road if Japan needs fast liquidity and turns to a bridge asset like XRP? Sure, it's plausible. But right now, there is zero documented evidence that any major financial institution is planning for that outcome. It's easy to see why this narrative spreads, because it generates engagement and excitement. But separating real research from speculation matters, especially when people are making financial decisions based on what they see online. The honest answer is that this remains a future possibility, not a current plan. And I think it's important we're clear about that distinction. Switching gears, let's hear what Versan from Black Swan Capitalist has been saying, because his framing of how this price action could play out is genuinely worth your attention. His argument is that XRP isn't going to climb in some smooth, predictable line the way a lot of traders expect. Instead, once real-world utility fully kicks in, meaning regulatory clarity solidifies, banks start actively using the network, and cross-border tokenization volume really takes off, the price action could become explosive and unpredictable rather than gradual. He points out that the underlying infrastructure has already been quietly built and tested for over a decade, sitting in the background waiting for the right conditions to align. When that switch finally flips, his theory is that we won't see gentle 2 or 3 times moves, but instead a series of sharp, fast leaps as short positions get squeezed and institutional capital rushes in all at once. Whether or not that plays out exactly as described, it's a compelling way to think about how utility-driven assets sometimes behave once adoption finally catches up to the technology. For years, institutional interest in building on the XRP Ledger was effectively frozen because of the uncertainty surrounding the SEC's lawsuit against Ripple. Companies didn't want to commit resources to infrastructure built on an asset that might officially be labeled a security. Now that the legal cloud has mostly lifted, the floodgates really have opened, and we're seeing it play out in real time. One of the clearest examples is a recent partnership involving Ripple, JP Morgan, MasterCard, and Ono Finance, all working together on the XRP Ledger to handle the redemption of tokenized treasury funds on an international scale. In a recent interview, a developer involved in this space explained that Ripple's long-standing reputation as a trusted financial infrastructure partner made this kind of collaboration feel like a natural next step. Building on relationships Ripple has spent years cultivating across traditional finance. What makes this particular pilot stand out is how it demonstrates the ledger's usefulness well beyond simple payments. Once an asset like a treasury fund gets tokenized, the real value comes from how easily it can then move, settle, and connect between on-chain systems and traditional off-chain financial infrastructure. The developer described being able to manage liquidity around tokenized treasuries and quickly redeem positions without the usual friction baked into legacy finance, something that's historically been slow and cumbersome. This isn't about replacing the existing financial system overnight. It's about quietly upgrading the plumbing underneath it, allowing institutions to do more with assets that are already in play without disrupting what users see on the surface. That kind of behind-the-scenes enhancement tends to be exactly how major financial infrastructure shifts actually happen, gradually and then all at once. This pilot also ties into MasterCard's own multi-token network and broader treasury fund tokenization efforts, all converging to support settlement between traditional financial institutions in a more efficient way. The bigger picture here is that nobody involved is trying to tear down the existing financial system and start from scratch. Instead, the goal is to unlock more functionality from assets that already exist, using blockchain rails to add speed and flexibility without forcing a complete overhaul of how everyday people interact with their money. And honestly, every single day there seems to be another headline involving Ripple or XRP in some new partnership or pilot program. Individually, any one of these stories might not move the needle much, but stack 10 of them together, then 50, then 100, and you start to see a much bigger pattern forming, one where XRP's underlying utility keeps quietly expanding in the background while most of the market is focused elsewhere. Now let's bring in Ashish Birla, who made a great point about why the XRP Ledger specifically is positioned well for this next phase of tokenization. His argument centers on the fact that the ledger isn't just a payments rail. It has a native, decentralized exchange built directly into its core architecture, something a lot of people still don't realize. That built-in exchange functionality makes it naturally suited for moving tokenized value efficiently, which matters a great deal as more real-world assets, from stablecoins to fund shares, start getting represented on-chain. He pointed out that tokenization activity on the XRP ecosystem has been steadily increasing, partly driven by stablecoin growth and partly through partnerships like the one with Franklin Templeton. According to him, the years Ripple spent quietly building licensing relationships and regulatory connections across the globe created the kind of real-world connective tissue that's incredibly difficult to replicate quickly, giving XRP a meaningful head start as tokenized finance continues to mature. Speaking of Franklin Templeton, their head of innovation, Sandy Call, gave us one of the more fascinating glimpses into where all of this might be heading. Franklin Templeton has actually been working with Ripple and building on the XRP Ledger for years now, dating back to before the SEC lawsuit even began, which means this isn't some recent trend-chasing move. According to Call, the long-term vision is that your crypto wallet eventually becomes the single interface for your entire financial life. Right now, most people juggle multiple checking accounts, savings accounts, brokerage accounts, healthcare accounts, and insurance policies scattered across totally separate institutions, making it genuinely difficult to get a clear, unified picture of your own financial situation, let alone optimize it effectively. Call went on to describe a future where all of those assets become interoperable inside a single wallet, allowing you to see your complete financial picture in one place and actually evaluate every holding individually. Instead of money just sitting idle, you'd be able to ask real-time questions about each asset, like whether it could be lent out for yield, placed into a liquidity pool, or staked for additional returns. Your everyday spending money, your long-term savings, and your investment portfolio would all become part of one connected system, letting you set broader financial goals like maximizing buying power or saving toward retirement, with the wallet itself helping figure out the most efficient way to get there. She emphasized that this isn't some distant fantasy either, pointing to the early stages of tokenized equities and bonds expected from major exchanges this year as the first real step toward forcing traditional financial institutions to adopt this kind of wallet-based infrastructure, even if the early versions are simply digital twins of existing assets, rather than fully native tokenized instruments. Let's pivot to something just as important for short-term price action, the Federal Reserve. New Fed Chair Kevin Warsh just gave a briefing, and it wasn't the news a lot of traders were hoping for. Despite earlier expectations of rate cuts heading into 2026, the Fed has now held rates steady for the fourth consecutive meeting, keeping the target range between 3.25% and 3.75%. There's even talk of a potential rate hike before the year ends. The reasoning comes down to two factors. Inflation has been ticking upward, sitting closer to 4% rather than the Fed's 2% target, and the job market still looks relatively stable on paper. Until inflation moves meaningfully closer to that 2% goal, a rate cut just doesn't make sense from the Fed's perspective, regardless of how much the market wants one. This caught a lot of casual traders off guard, but if you've been paying close attention to the underlying inflation data, this outcome really shouldn't have been much of a surprise. Let's also touch on some international developments, because regulatory momentum is building outside the US too. Indonesia's Financial Services Authority is preparing to release a formal, real-world asset tokenization regulation sometime in the third quarter of 2026, signaling that the country is actively moving toward clearer digital asset rules. Alongside that, there's been an expansion of XRP-based international money transfer services, with Ripple's payment infrastructure gradually rolling out across the Philippines, Vietnam, and Indonesia through a partnership involving SBI Remit. This kind of steady, less flashy progress across Southeast Asia often gets overshadowed by bigger headline-grabbing announcements. But these remittance corridors represent some of the most practical, real-world use cases for XRP that already exist today, processing actual cross-border payments rather than just theoretical future scenarios. Now let's get into where price actually stands right now, because I know that's what a lot of you are here for. XRP has been under pressure lately, and we did try to push through resistance around the $130 level. But that attempt failed and price got pushed back down fairly hard. A big part of this pullback ties directly back to the Fed holding rates steady instead of cutting, which tends to pull liquidity out of risk assets like crypto across the board. There's also been some uncertainty tied to ongoing negotiations around the conflict between Iran and the US, with reports suggesting the US could end up committing a significant amount of money as part of a broader deal to wind things down. And markets generally don't love that kind of fiscal uncertainty. Whether this pullback ends up being short-lived or sticks around longer really depends on what comes next, both from the Fed and from broader macro conditions. The encouraging sign is that ETF inflows have continued throughout this dip, which suggests longer-term institutional appetite hasn't disappeared, even while short-term price action looks shaky. So where does all of this leave us? On one hand, you've got bold predictions from people like Jake Claver and frameworks like Verson's violent leaps theory, painting an exciting, almost inevitable picture of where XRP could be headed. On the other hand, you've got real, confirmed institutional activity, the JP Morgan and MasterCard pilot, Franklin Templeton's wallet vision, expanding remittance corridors across Southeast Asia that's happening right now, regardless of price action on any given day. And then you've got macro headwinds from the Fed holding things back in the short term. The honest truth is that nobody can promise you exactly when or how high this goes. But the underlying infrastructure story keeps getting stronger month after month. And that's worth paying attention to no matter what your screen looks like today. That's going to wrap things up for today's episode here on Coin Crusader. There's clearly a lot of moving pieces right now between the institutional momentum building quietly in the background and the more immediate pressure coming from the Fed and broader macro conditions. I'd love to hear what you think about all of this down in the comments, especially whether you buy into these bigger price predictions or you're more focused on the slow, steady, institutional build-out we've been tracking. As always, thank you so much for spending this time with me today. Make sure you're subscribed so you don't miss what comes next, and I'll catch you in the next one.